Hi, this is Bobby Ewan, founder of Elevate Financial and managing partner of Universal Producers Group. This quick video is actually going to be on setting your child up for success. There's a lot of YouTube videos, a lot of TikTok, Instagram videos out there talking about being your own bank. And this one we're really going to break down the proper way to leverage cash value life insurance because there is so much misinformation. I want to make sure that you at least have the basics of what it can do and what it cannot do. Okay. And so I would encourage you, whether this video was shared with you with somebody from my team or you want to speak directly to me, go ahead and book time on my calendar and we'll break it down. We'll create something custom that kind of fits more of your all's needs. Okay. So let's dive into it. I'm going to share my screen here and we're going to get after it. All right. The first thing that we need to understand is why life insurance, right? So for the majority of people's understanding, they understand term insurance, typically on the parents, especially if they're income earners and other people are relying on them. And we love term insurance. You can buy a lot of it and cheap. We're 100% independent. So if you need help shopping your term insurance, maybe things have changed since you put it in place 5, 7, 10 years ago, or maybe you have a term that's about to lapse, right? And you need to have some new term in there. But with term insurance, we always want to have at least 10 to 12 times income. If you're the sporting spouse staying at home with the kids, I mean, that's a heck of a job right there. We want to have at least 300 to 500,000 on the supporting spouse or partner as well. Okay. So just really quick, going back into permanent life insurance, why? Well, there's some amazing tax advantages with permanent life insurance that, our affluent clients, the wealthy have been using for years. Sometimes people like to call them tax loopholes, but here's the long and short. It's called the rich man's Roth because there's no funding limit like a traditional Roth. If you make too much money, or they cap how much you can actually put in per year, 6,500 if you're under 50 years old, 7,500 if you're over 50 and you're trying to play catch up. But with the rich man's Roth, there's no limit on how much you can contribute, and there's no limit on what your income is. So this is why this is another bucket. So again, we like Roth IRAs, we like Roth 401ks. Go ahead and get the IRS divorced. But what are the other options that are out there? And so we're going to talk about laying the foundation for our kids. And this is also what I kind of like to call the Gerber plan, but on steroids, because we're going to overfund these policies. Okay. And we're going to buy the minimum amount of life insurance because life insurance is a cost. We need to minimize the cost inside these policies to make them fantastic. So we're going to minimize the cost by minimizing the life insurance. There has to be a need for some protection. It's always a good idea for our kids. Kids can't have term insurance. It's a good idea to put some protection in place on them to protect their future insurability, right? They might be healthy now and then something pops up in their 20s, God forbid, and we can't go out there and get a new policy on them. And then lastly, this is a sad story. We don't like to talk about it a lot, but there was an incident with a 6-year-old that had a terminal cancer, and the parents were able to accelerate the benefits on their policy because there's riders included in here for long-term care, for critical illness, for terminal illness. They were able to accelerate the death benefit. The parents were able to, the child unfortunately didn't have a lot of time. They were able to take that money and replace their income. And they just had a great year taking them to Disney, doing some trips like that, spending the time that they needed to. But they're only able to do that because they're able to accelerate those benefits there. Okay. So this is also referred to as a 7702 plan, Rich Man's Roth, but the real name of the contract is called an IUL, Index Universal Life. And so we're going to explain what that means because your money is going to be growing with the market, but it's not actually in the market. So I'm going to break down how that works as well. Let's dive into an example. And again, I'm going to show you a 2-year-old. Okay, we can set these up as soon as they're 1 month old, or they can be much older. I really wouldn't fund this policy if you're not committed to doing less than 100 a month. But in this range, I'm going to show you 250 a month, right? 3,000 a year. That could be paid monthly, quarterly, annually if you have a bonus. These are great grandparents plans, right? So if you have a grandparent that's already putting money in the bank, just a savings account, regular old savings account, let's redirect that to this permanent policy because guess what? This has the same functions, and that's why they call it being your own bank, because you can nearly access this money anytime you want. And I'll explain what that means. So there's no waiting till 59 and a half. It doesn't have to be used for college. So a lot of people like to use these as an alternative to 529 plans. It doesn't count against them on their FAFSA as expected parent contributions, right? And then maybe they don't want to go to school, and maybe but they need some money in their life to further their career doing something. And then we can kind of parlay this into putting a down payment on a house or paying for a wedding or whatever that need may be financially. Okay, so let's go ahead and dive into it. Again, I'm not going to go through every single detail. This is why you need to schedule some time with me. We'll create a custom plan that fits for your family. But in this example, I'm using a 2-year-old, and we're going to fund this policy. This is called flexible premium. The maximum we can put in is 250 because that's based on this design. If you want to do 300, 400, 500, we need to set up the policy correctly from the very beginning. We can't, after it's set, we can't adjust that, but we can always contribute less. So the maximum is 250 a month. I believe the minimum on this policy is about $40 a month. So in case there's a month that just, things are tight, you can always do flexible premium with that. So in this example, we start with a 2-year-old. We're going to fund it 250 a month. Okay. And we do get some death benefit right out of the gate. We get about 300,000. Okay. We don't need it particularly, but it's a nice to have, right? And you're going to see all these different columns. Let me break that down. The first set of columns are your guaranteed assumptions. This is if the stock market never ever grew or was negative every single year. That's never ever happened. So we don't spend a lot of time on that, but contractually we have to show you. The middle is if we just want to pick that fixed account. If you think that the stock market's in for a bad year, pick the fixed account at 4.75 and lock in those gains there. The non-guaranteed assumption over here, we're using 7%, even though these policies have done 8 and 9%, we're using 7% here. And I'll show you the historic look back on that. But let's kind of fast forward. So, hey, when they're 16, what are you doing? I'm not buying my child a brand new car, but I do want a few thousand in there to be able to assist them. So by funding it 250 a month, by the time they're 16, there's almost 57,000 in cash. And you can see that this is cash surrender is the same as cash value. And this is the money that you have access to. Now we're going to take it out the smart way via a policy loan, and that's the loophole. So we use after-tax dollars to fund these policies. They grow tax deferred. We can access them tax-free whenever we want. And when they pass, it goes to their beneficiaries tax-free. So that's the benefit there. There's just a massive amount of tax advantages, and this is why our wealthy clients prefer to use this method. Okay. So there's money in there. We can also obviously see when they're 18, 19, 20, 21, there's about 100,000 in there if they want to use that for school. Okay. As the cash value grows, so does the death benefit. Now, what's happening in their mid to late 30s? They're probably trying to buy a house or trying to get married. Maybe they want to start a business. I call this the bank of mom and dad. So at any point, once they have consistent income, you can turn this over to them, or you can keep it for yourself and you can use it to fund your own retirement. Again, we can set up policies for adults. So if you want to look at, well, I have this kind of much money in my life, I want to put together a retirement plan, we do that as well. Let's set up a consultation for that. But in this plan, we're just going to continue to keep funding it, right? Whether it's the child at this point, but we're going to fund it all the way to age 60. Now look at this. $250 a month means over the course from 2 years old to 59 years old, we put in a total of $171,000. But look what it's grown to 1.8 million, a little bit more actually. The death benefit's grown to 2.5. And why is that? Because our money's not in the stock market, but it's tracking how the market does. I'm going to show you that next. But look at this. Instead of funding it, we're actually going to turn on distributions from it, tax-free distributions to supplement, our Social Security, our pensions, things like that, our rental income. So $160,000 a year is a fantastic, supplemental income to benefit them in retirement. Now, will $160,000 feel like the same that it is today? Absolutely not. But again, it's a great foundational for them, and it's completely tax-free. Even if taxes go up, doesn't matter. We already divorced the IRS and go. But look at this. By age 82, same thing. We put in 171,000. According to this distribution schedule, we've taken out 3.6. And should they pass at age 82, they're still $1.26 million. So that 3.6 plus the 1.2, that's the combined benefit of doing a plan like this. But check this out. If a 2008 happens, right, again, where the market dropped, housing's dropped, this bank right here, they can access up to 90% of this cash value anytime they want, no questions asked. And so maybe they're able to take advantage of an opportunity, or maybe they have an emergency. Maybe they get laid off, right? In 2008, when the market dropped 40%, they were getting laid off. and their account was down, but they didn't want to lose their house. So what do? They robbed their 401ks. They got hit tax and penalty, right? So talk about getting kicked while you're down. In these solutions, you can never lose money due to market drops. So if the market drops, you get credited zero that year. They're going to take out a small amount for the cost of insurance and the fees because there was no growth that year. But again, we call that zero as the hero. And here it is right here. These are the indexes we can track. I'm not going to spend too much time on this. We'll slow this down and go through the nuts and bolts on this on our meeting. But we're going to pick 50% to the S&P and 50% to the Barclays. Okay. Now we remember we cannot lose money with this strategy, but we also are giving up some of our upside, and that's okay. We call this our safe money. We're hitting singles and doubles. We're looking for a net of 5 to 7%. So again, way better banking alternative. We're not saying that this beats the stock market, but it has other benefits and features that the stock market can't give us. But check this out. If the market dropped like it did in 2008, 40%, they're going to credit your account 0.25. Okay, so you don't lose any money. Now, that next year, the market bounced back 27%. Everybody else is still in recovery. I think the market didn't even recover until 2012, right? But in this chance, you just, it's kind of like having a crystal ball. You set out that next year, the market went back up 27%. You're going to participate up to the 12% cap in that. They're not keeping the difference. I'll explain how that works. But look at this on the Barclays index, they're actually giving you a participation rate of 170%. So if the Barclays does 10, they're crediting you 17, and they're giving you a 1% bonus on that. So you're not giving up double digit growth just to have a product like this. Okay. And you can see historically it's done over 8%, sometimes 9. But again, we're going to shoot for an internal rate after fees, okay, of 5 to 7%. This was a lot of information for this first introductory call. I would highly recommend that you schedule some time with me. Let's run through some custom numbers and see how it could fit and benefit your child and put them into a position. Remember, compound interest, right? The eighth wonder of the world. The sooner that we get started, there's always 3 factors. It's time. That's one of our biggest assets. It's paying ourselves first. So we're contributing consistently on a consistent basis, right? And it's rate of return. So those 3 factors: time, contribution, and then what is the growth rate? Okay, but again, Bobby Ewan with Elevate Financial, 100% independent. I want to sit down with your family, see what we can do to put you all in a better position, and from there, money isn't everything, but it sure does buy a lot of opportunities, right? It can fix a lot of problems, whether it's paying off debt or just putting yourself in the best position, because guess what? Unfortunately, there's a lot of people that weren't disciplined to pay themselves first, and typically they got to continue to keep working at Walmart because they didn't put any money away. It's unfortunate, but let's get you in a position to where an early retirement for them, for you, is possible. And again, I look forward to talking to you. Have a great day. Bye.